All right, ladies and gentlemen, welcome back to another episode of the Market MadHouse Show. My name is Cyprian Francis, and with me, as always, co-founder of Madison Trading House, Mike Patton. Good morning, Mike. How are you?
I'm doing great, Sip, and I'm good morning, everyone, as well.
To, Today is a big day, right? Fed Day. We're
Yes.
going to be getting a lot of info. I feel like the market is kind of just teetering here, waiting till the news comes out. What are your thoughts on everything?
Yes. I mean, right now, markets are not doing very much. We're up 0.61% on the SPX at the moment. If I jump over to a chart of the SPY, let's see what it looks like now. Um, close.
Oh,
Right now, looks let's look intraday. Right now, yeah, pretty flat, not doing much at all. So I know the market is waiting for sure because a couple of things. Powell was quite clear. Okay, so we talked about this last time. Let's just repeat this for those who may have missed it. Powell is and has been very clear that public enemy number one is inflation. Like he's not mincing words. He's not dancing around it. He's not trying to soften a blow. He is saying flat out, this is what we have to take care of. And if anything has to suffer as a result, so be it. So that's how clear and firm he's been. So he said he's not thinking about employment. He's not thinking about people, losing their homes. I mean, he's not thinking about any of that. I mean, that's all secondary. Primary focus is inflation. Now, to me, that means that they must be really afraid of it because otherwise, why would they ignore everything else? So the Fed is expected to raise by 75 basis points, which is what they did the last time. But there is a chance they could go one full basis point. But more importantly, again, Powell's wording makes it clear that it's going to keep going, right? So it's not like something where if something looks a little bit better this time, they'll leave it alone. No, this is clear evidence that until they've got this fully under control, they're going to keep raising. Now, to put that in perspective, we're over 8% inflation. We're supposed to be at 2%. So we're way past where we need to be. And back during the post financial crisis, we had the Fed constantly chasing a 2% inflation because we were consistently under that. Now they're obsessively trying to get us back down. So I do believe the entire market is waiting for what Powell or what the Fed's going to decide to do. Um, if the Fed surprises and they raise less than 75 basis points, I think that would result in a huge rally in the market. But if they raise by 75 basis points, I'm not sure how the market's going to respond. I think everyone's expecting that. If they raise by 100 basis points, then I do expect that will have an immediate negative impact on the market to bring us down to lower levels because logically it should. If the cost of money goes up, then naturally business profits and consumer spending and debt borrowing should go down. So we'll see.
Yeah, and there's more to the story than just the interest rate, right? Like you sent me this article. I'm going to go ahead and throw it into the chat, but it's going to be the tone of what they're talking, some of the things that they're talking about. There's
Right.
going to be some sort of dot plot data, some quarterly stuff. So, when the rate decision comes out, I feel like we're going to need to run through everything to really get a sense of what they're leaning towards. And then I was just kind of trying to look back at the historical uh, rate, at which we've had interest rates. And we're going to be, if we keep going up at 20, 50 to 75 basis points, we're going to be in levels we haven't seen in like 20 years or so. So,
Right.
like the modern day consumer is going to be really being reminded of what things used to be like, right? Like how we need to adjust the economy to deal with this thing called inflation.
Yeah. I mean, unquestionably, none of us have experienced interest rates like this in a very, very, very long time. I do actually remember when interest rates were lower, were sorry, this high before, and then they went down, for a long period of time. So It's been very easy over the last 20 years or so to borrow money at low interest. And of course, if you're a saver, if you're a person who is retired, et cetera, you got money in the bank. I mean, I remember when my mother used to, we used to talk about CD rates. I mean, this is like literally 20 years ago. We were talking about like, she's like, well, I can get this one, it's going to give me 7%, but I can get this one, it's going to give me 5%, but it has a better this. Those conversations disappeared basically around 2011. Since then, it's just been like, man, you get 1%, 1.5%, you're happy, right? Which is pathetic, absolutely pathetic. Ironically, technically, it was keeping pace with inflation at the time, but we all know that that's not really the truth. Prices were definitely going up. So now we have rampant, out of control price increases. One statistic I heard is that they're expecting this winter energy bills are going to go up about 30% for most people. And that's on top of the increase we've already seen. In Europe, they're seeing, energy prices up 150, 200% or more. So with that in mind, with prices going up this fast and all of the impacts, and we'll go over Ford because they're actually being impacted by this very obviously, as are a lot of other companies. So with this level of price increase, interest rates by default, that's the only weapon that the Fed has to fight inflation. But I mean, it's going to take a lot of time, in my opinion, for that to really undo what's happening now. And that assumes, by the way, that we really can do it that fast. I'm still firmly expecting stagflation. I've been expecting that since 2020, and that's what we've been seeing. Stagnating growth, increasing inflation, just like we saw in the 1970s, and that lasted a very long time. For those, I was alive in the 1970s, but I was too young. I was a baby, but basically, for people who lived in that period, they all, everyone's got plenty of horror stories about the 70s. Well, it's going to be worse this time for sure because there's just so many more problems than we had then. So yeah, I guess the Fed has no choice. I mean, that's the bottom line. Everybody's going to look at the data points, et cetera, but I think it's all going to point to the same conclusion that we still have a real problem. And one other thing I'll mention, President Biden was being interviewed. I think it was on ABC or something. And I didn't watch the whole thing. I never do. I don't usually watch things like that because I'm like, yeah, I already know what they're going to say. But what was interesting is when they point out the inflation part, he said, well, it's stabilized. It's at 8%. Like, okay, does he not get what that means? So I guess because the rate of inflation didn't increase, he's fine with that. But I'm like, geez, oh my goodness, guy, you don't get it. All right, never mind. But there you go.
So let me ask you this, Mike. So what would force the Fed to go 100 basis points instead of 75? Like, is there anything in the data that's come out that's like we need to be more aggressive? Because 75 is pretty damn aggressive already.
I think I think yes, there is something that could. I don't think we're going to see it. But they still might still do it. So here's what I would say. I really think that at the end of the day, um, if they raise interest rates that fast, that means that they must be expecting inflation to really kick up in this next quarter. Now, my guess is that maybe it will, but there's a few things that could mitigate that. Um, we've noticed that layoffs are increasing. The fewer people that are out there who are consumers, the less spending, and that does dampen inflation if no one really has money to spend. So even if you have a lot of money out there, if people can't spend it because it's locked up somewhere in someone's bank account and they let go of their employees, so they're not paying anybody and it's just sitting there. Well, uh, probably they're not doing a lot of purchasing. So usually people, they'll invest into stocks or real estate or things like that. But when it comes to actually putting the money into circulation through the economy of goods and services, that's another story. So if a lot of people are losing their jobs, then I think things will actually cool off. So if they think, I believe if they think that that's the trend, that consumers are going to be able to spend less for whatever reason, I do think that they would hesitate to go up to one percentage point. But if they think spending is going to increase and they think that the momentum of activity is going to continue into the next quarter, then that would be the only reason I can think of they would raise faster. But again, these guys look at a lot of stuff, so I don't want to say any more than that. But I do think those would be two major considerations that they should be looking at.
Yeah, I feel like this afternoon is going to be pretty active one way
Yeah,
or another. I feel like there's going to be a lot of action. And then real quick, just an update on oil, right? Energies are driving a lot of this inflationary pressure.
right.
We've had some numbers. What are you seeing?
Inventories built, they went up by 1.1 million barrels, meaning that there was less demand than on incoming supply. Um, I'm not sure. it- Usually, like we're at the end of the summer, so that's one thing to consider. People tend to travel less, but as we get farther into the fourth quarter, into the fourth quarter, we're going to see people traveling more, etc. So again, I think most of this, when it comes to inflationary pressures, comes down to how much people can spend, and also supply chain. So it's a combination of both: how much people can spend and what's available to buy. Right, inventories are very low for a lot of things. So with the oil numbers, the market was expecting a larger build in inventories than we got, which means that demand actually was larger than expected. So it was still um, more supply than demand, but the actual demand was larger than expected. So that's a data point that probably is going to, well, it came out today. So the Fed, I don't think they're going to change their mind today, but in the future, they may look at that. If we keep seeing surprisingly more demand for oil and energies than what was expected, then I would expect that that would be a incentive to try to raise interest rates even more. So when oil inventories built, a lot of people, when they see oil inventories go up, they're thinking like, "Oh, it means that oil prices will have to go a lot lower." Well, not necessarily, because again, it really depends on what's expected versus what actually happens. So if the expectation is one thing, but more demand is there, that actually will always be bullish on oil prices. So looking at USO, which is an ETF for oil. It's currently down 0.64% today. So we do see a decline in oil prices for the day. And if we look on a 3 month basis, clearly oil prices have been on the decline. But what is interesting, and this goes back to one of our previous episodes when we're talking about this price channel, basically we're hovering on the lows, and it looks like from my eyeball that we're actually seeing the signs that a reversal might be in play. When I say might be, you never know for sure, but you can tell when the market is anticipating something, and this is what it looks like they're anticipating, that this may be the lower end of where prices should be. So larger traders who have various reasons to be in the markets may be eyeing prices going higher, waiting for the right data points. Now, of course, if the Fed comes in and raises interest rates more than expected, that should push down oil prices for only one reason, and that is that if the interest rates are up, the dollar value should strengthen, which means that the dollar buys more stuff, and therefore that would soften oil prices. So we'll see what happens, but I do think that no matter what, interest rates or no interest rates, demand for energies should go up as we get farther as we get into the fourth quarter, especially if we have a cold winter. And let's keep in mind, Europe is a huge buyer of U.S. energy right now because of the war in Ukraine and the basically the counter moves that Russia has made in response to Western sanctions. But also, the EU says they're going to do an oil embargo on Russian oil. I believe it's going to start in December or thereabouts. So if that's the case, that supply is no longer coming in, and it's going to be replaced by someone, and probably it's going to be us, and maybe someone else. But at the same time, our energy output is really stretched to the limit now. we haven't opened up new oil drilling. We haven't opened up new supply. And even if we did, it would take some time for that to come online. It's not like you turn a switch and it's suddenly there. You have to build up, you have to build the infrastructure, or, you know, drill again or whatever. So I'm not an oil expert, but I do know from the people I know in the business that it's not like something you can just snap your fingers and it's done. So with that in mind, we should see more pressure on prices to go up. So the bills that we're seeing in inventory right now, and I wouldn't think of them as indicative of what the long term picture is going to look like. I think we're going to see more drawdowns than builds going forwards.
Yeah, every time you mention energies and the costs going up, I feel very grateful for moving to Southern California, because I'm like, man, it's just like 80 degrees every day.
Well, you guys still have to generate electricity, and that's going to come from a variety of sources. But I will give California credit. You do have probably the largest. I mean, you got sunlight all the time, so solar actually works in your state, whereas in everywhere else, it's kind of
Yeah, I
questionable.
mean, we got our own problems, but like an energy bill, it's not something that I lose sleep about. But
Yeah.
when in terms of having the crystal ball, I'm assuming people are watching, listening for the first time, and they're like, "Oh, Mike, why does Mike know what's going to happen to oil and this and that?" And part of why is the Madison trading software. So
Right.
what we're going to be doing in the next segment is going over a couple of names that have come up in the scans, have come up using the proprietary AI powered software to really run through all this data very quickly to find these opportunities. And then the charts and the signals and the data points that you're seeing on there, they all have a meaning and they all have a purpose. And that's the power of Madison Trading House. And so what we're going to do is throw the link into the chat. So if anybody wants to follow along, grab a demo, test out some of the features for yourself, I'm going to go ahead and add that in there so people can jump in and engage and check out this amazing, powerful software. Otherwise, we're waiting for the big Fed meeting today, and we've just got some other names in the news and some names that are coming up on the scans. And so earlier in the show, you mentioned Ford. So
Yep.
let's dig into Ford. It's in the news. They're feeling the pressures. But what's the software telling us? Is there a play? What's the crystal ball say?
All right. Well, firstly, the way Ford came up, ironically, was not for bullish reasons. It was actually for bearish reasons. Yesterday, the stock took a really sharp dive. Now, it doesn't look as impressive when you look at it from this context, but at the time, that was a fairly big drop. So this was on the 20th. So here's what happened basically. So the software, I was looking around to find stocks that are breaching the bottom of this price range. The MTH vol study. So let me just minimize these others for a second so we can zoom in on that. So, oops, did I just hide that on accident? Sorry, I just hit it on accident. There it is. So this is the MTH vol study. One second, sorry, I clicked the wrong thing. There we go. These this blue channel, and when you get to the bottom or the top of this range, it does mean something. It basically means that the market has made an extreme move in a short amount of time. In other words, if the same distance were traversed over 2 months, no big deal. 2 weeks, no big deal. But over a few days to get to this side means that you really are figuratively off the rails, like the train's literally going off the rails. So when this happens, there usually is a pullback that brings you back into the expected range. For a major stock like Ford, this is very, 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 very unusual that we're trading this far outside. Usually we'll peek our head out the bottom or out the top and then come back normal. Like as you see up here, for example, you get right to the edge, you touch it, and then we don't want to go any farther. Then we come back down. Now, this may seem like if this is the first time you've seen this study, if you're a subscriber, you've seen it plenty of times and you understand this is a very accurate tool. But at the same time, if you're new to this, I can assure you that this is not coincidence why this happens. It's basically because the software is analyzing the sentiment that's already built into the prices that are trading in the markets for stocks, options, and surrounding information, fundamentals, valuation, etc. So when we look at this information, it's really giving us a window. So on the surface, this could be a buying prospect, but I will warn that in extreme circumstances, you want to be very cautious. I want to actually see the market able to recover and recoup these losses. And I need to see that happen soon. Why do I say that? I'm going to use an example that's extreme, that is something that happened recently. You guys all, we covered Bed Bath and Beyond weeks ago. When this breakout occurred to the top, let me just get rid of the rest of the studies here so we don't see them. When the breakout occurred at the top here, and this was on the 5th of August, this means that the market was not expecting this level of movement to occur in that short of a period of time. And then it just continued. Now, usually when you get to the top or the bottom, like I said, there's usually a tendency for a rapid reversal or a stagnation of movement where you're just moving along the line. You're not able to get away from it. In this case, we just broke out, made this huge move up, and then eventually we come back, and now we're back to normal. Now, this return pattern is also normal. This is how it usually works out. That you get that one big exception sometimes, and then everything goes back to normal. But when you're dealing with stocks like Ford and Apple, you're not dealing with a short squeeze candidate. In other words, you're not seeing huge trolls of people online trying to push a stock up. So in the case of Ford, this is a normal stock, and normal stocks usually can't get that far outside of their projected range. So if they do, that means something really big has happened. So right away, this is warning us to be cautious based on the nature of the stock in question, that we should be very cautious about buying Ford. So if you're thinking about buying Ford, I would say hesitate to do so. And I'll tell you why. Now, when we read the article, which of course the Madison platform allows us to check out news as well, all I have to do is click right here, and I can see my news feed, right? So I can get some pretty good feedback on what's happening. But more importantly, if I read one of the articles that came out about this from CNBC, I'm looking at another screen, so apologize for looking in the other direction. But Ford stock suffers worst day since 2011 after cost warning, shedding $7 billion in market value. So here's what they said. Uh, the stock basically was down 12.3% yesterday. Okay, so that's what I said. That's a big move for a stock like Ford. And the reason why it was down was because the company pre-released part of its third quarter earnings report and warned investors of $1 billion in unexpected supplier costs. Now, what does that mean? Well, supplier costs basically means you got to get your parts to build your vehicle, right? These days, it's a global marketplace, global supply chain. So you're not getting everything from Detroit. You're getting things from China, you're getting things from India, you're getting things from Germany, all over the world. So supply chain costs naturally go up if the price of energy goes up, which it has dramatically. You have sanctions that are actually disrupting the normal flow of goods around the world. You've got all sorts of other backlog problems from the post pandemic, or I guess current pandemic. So with all those things in mind, Ford's costs are up. And what they're telling everyone is that these increased costs, $1 billion in surprise expenses, is not a small deal. That could easily wipe out any gains, any profits that might have been made. So Ford has some hot items, like the new full size Bronco is a really hot seller, right? I want one. I haven't bought one yet because I don't want to pay over MSRP unless I want to travel to another state to buy it. But at this point, I kind of want to see the next version. I'm just kind of digressing there, but I just want to see the next version to see what they improve. Usually the first one's not so good. Anyway, long story short, Ford's costs are up. They got to spend a lot more money. You have labor costs too. People are getting paid more than they used to. It's harder to get people to work, so you have to pay higher wages, and just stacks up over and over. So in short, these guys could see their profits wiped out. All right. So if I look at Ford from the software, it does show fundamentally the company is sound. I mean, it is making money, but after this pre-release, we might expect that once the actual earnings information comes out, that may change the estimates, that may change the profile of what we see for the stock. So right now, it does not look so bad. For example, in 2020, they weren't expected to make anything more than a penny per share, but they actually made 41 cents. So think about that. In 2020, everyone's thinking Ford's no way they're going to make any money. Oh yeah, they did. They made 41 times what people expected. Um, and then in 2021, they basically met expectations. 2022, we're currently in it, but we're expecting that they're going to improve over 2021. But 2023 is expected to be flat. So Ford's not on a growth trajectory. Okay, if we look at the sales, they're kind of flat. You're not seeing this accelerating curve up. Just to show you what that would look like if they were. Trying to think of a stock that would be a good example of this. CCRN maybe. Um, yeah, that's what you want to see on sales. You want to see that accelerating growth, but you don't see that in Ford for good reason because their sales are fairly flat. So they're maintaining, they're not losing money per se, but they're not gaining much either. But with this announcement, this could wipe out any profits they may have made based on their supply costs. Now, currently, the median projected upside for the stock is 17.29. The lowest projection is 10. So that's 350 below where we are now at 1350 versus about $4 above to the upside for the median expectation. Not the best reward to risk there, in my opinion. So if the earnings come out and they're surprisingly better than expected, in other words, that extra 1 billion in cost, if they can overcome it by some blockbuster earnings that that get rid of that loss, then perhaps this stock will be on a move. So my strong recommendation at this point is if you're a long-term believer in Ford, now's probably a decent time to buy. If you're looking for a short-term move, wait till it's crystal clear that the market's recovering. So it's got to start going back up, something maybe like what happened over here, where we start to see that trend emerge to the upside after that big dip. We should at least be able to get back to the middle of the range. But nevertheless, when earnings come out, we have to bear in mind that the earnings could be a big surprise. So last earnings came out in July. Let me see when they're due for earnings. Wednesday, October 26th is going on the platform. Wednesday, October 26th is their next earnings. So that is a month from now. So that's not that long, 35 days. Analysts are currently anticipating 54 cents. But again, that supply chain cost could actually eat that away. So we'll see. So just be cautious for now. Technically, it's not looking good. Inner Circle is not showing any real buying. In fact, we're seeing mostly selling of Ford as far as institutional ownership is going down, meaning that fewer institutions want to hold this. So this is a company that's on the rocks, but I do think that long term it has value. I do believe in Ford personally, but at the same time, I realize that we're not in a strong value proposition at the moment. So I would say if you're long term, maybe buy it, but if you're not, I would say wait.
Yeah, and it seems like they're finally catching up to the big electric wave in
Yep.
terms of the quality of their products. So definitely not a growth stock, but a staple of America, right? The Ford Motor Company. So
Yep.
we'll definitely keep an eye on that. Love the analysis. Moving on to our next name, and now I'm assuming that this one. I'm assuming that this one came up on your scanner because when I pulled it up on my end, it was just green across the board.
That's
And this
right.
is a company that I've never heard of.
Yep.
Model N, ticker symbol MODN.
Yes.
Should we look to buy?
I think it's a buy opportunity for sure. Okay, and this is a stock I literally had never heard of until I went to the scanner today, as I typically do. Went straight to my scans. I went to the score, and then after I got to the score, I looked for all green, and I said, "Hey, let me just look at this one stock that's all green that's new today." So I clicked on it, and there's our guy. And it doesn't trade a lot of volume. This is a very slow trading stock, but it does look like it has some quality. So this is a sort of stock where I always think these are good opportunities to be in if you're willing to park some money and let it sit for a while. So here's why. This company, first of all, is not a big company. It does have options, so that actually helps in my analysis. Has 982 employees, which is not a lot. So what do they do? Well, what they do is they are a provider of revenue management cloud software solutions for life science and technology companies. The firm has three primary software applications: Revenue Enterprise Cloud, which automates the execution of pricing, contracting, and compliance; Revenue Intelligence Cloud, which provides analytical insights into revenue management strategies; and Revi, which provides predictable pricing capabilities. Now, all that went right over my head. I get what
Look,
they're
Mike,
saying.
I was thinking I'm a smart guy and I have no idea what the hell that means.
so so I have some idea of what that means, but basically this seems to me the realm of corporate finance that I would say I don't know. So this seems to be
Like those consulting companies, right?
yes, yes, that's exactly what it sounds like. It's in that. But obviously, there's some benefit to this. So therefore, they've got some momentum. Now, their current market cap is substantial, 1.16 billion. So they're not that tiny, but they're not trading that often either. So this is not something that you want to be in if you're looking for a quick buck. You're looking for something that can grow over time. So let's look at the stats. Firstly, technicals are solid. We can see that over the last 20 days, it's been mostly going up. If we look at it over the longer term, which I'll look at now, does seem like it has some good momentum. I'll see what the 3 years look like. So it's been all over the place. So it doesn't look like it's in a particularly unique price range, but there is something I see on here that gets me very interested. These E's at the bottom are earnings results, and they're all green, which means that every earnings report they've had that I can see over the last 3 years, they actually did better than expected. Now, that is impressive. That's very impressive. Very few stocks are going to have that many greens. Now, possibly it's because not a lot of people are watching the stock, but nevertheless, if the estimates are consistently coming in better than expected, that's a big deal. All right, so they've been doing fairly well. The stock is not growing right now, so let's see if there's any problems in the revenue stream. So far, it looks like it's fine. Sales growth is definitely going up. Net income is not. Net income is more negative. It did improve here, about 5.71% improvement from the last reading from last quarter. But these numbers are still under zero, which means that the company is losing money. Now, my personal opinion of this, based on my experience, is that when you look at net income, if it's negative, it doesn't necessarily mean that that's a bad investment. Remember, a lot of these newer companies, they have to grow. And if they have to grow, they have to go through the phase where they're not making money, but they're reinvesting into their business to make it more profitable. Amazon went through this, Tesla went through this. These are normal things. Microsoft, all of them did the same thing. So I don't know if this company's ever going to be in that league, but I can definitely say this part here is the proof positive that they're on to something. If you see a constantly increasing revenue stream, that is proof positive that your company is making progress, making good headway. Also, their cash flow is positive. It actually is increasing over time, which is also not something you typically see. So, based on the sales growth, based on the cash flow, and based on the fact that the profit margin is actually improving over time, I do have to say that this company appears to be one that's going to break profitability. And if I look at the earnings reports, you can see that this was the lowest, meaning this was a loss. They lost money, but you can clearly see that these are going up as we go farther along. That's also a good sign. So earnings results, if your company consistently has earnings results that are getting worse, that's one thing. These are improving, so that means they're getting closer and closer to profitability. And if I look at it on a yearly basis, I see the same thing. From 2000, looks like they've been around since about 2014 or so, but from here going forwards, we can see clear improvement. They actually were positive in 2019. The market expected a loss. That's why you have the orangish brown slab at the bottom pointing down. That basically means that the market was expecting them to lose money. They actually gained money. And the same thing happened in 2018. The market was expecting a deep loss. They actually had a gain. So it looks like this is a company that can surprise on the positive side. And also looking at the estimates consistently, as I mentioned, they're doing better than expected. Everyone's expecting them to lose more, but they actually lose less. Looking at the analyst estimates, this looks really good. The lowest target is 34. We're at 31.97. So we're below the lowest analyst target. The second, the median is 39.17, which gives us about $8. Uh, well, actually less than that, about $7 of potential upside. And then the highest target is 45. So if I've got a price that's already below lowest estimates, if I see an improving financial picture over time, that doesn't look like a bad deal. Let's see if other people agree. Looking at the institutionals, they're up 2.94%, 20 more buyers, 22 fewer sellers. It actually is down in one additional top 10. Money flow actually is positive for the last 5 days overall. So I would say, yeah, this is looking like a good one. So since it came up on the list, I just wanted to see if it looks like a possible investment. It does. Now, the next thing I would do is look at the chart and just look at the timing. Now, this is where I would say we probably should wait. So let's kind of look at the history of the stock. Generally, it looks like when it's on a trend up and it gets to the top of these price channels, there's a tendency to come back to the middle, go up, come back to the middle. So I would say right now, you can see that happened over here on the right. Let me just zoom in so we can see it. So on the right, we had the big push out, and then as you can see, it comes back down to the middle, and now we're right up against the top again. So probably we can have a chance to get in on a pullback. Um, with this one, like I said, I don't. It doesn't look like a runaway freight train type of trending stock. It looks like it's going to take a while for it to build its value, but it looks like we've already passed the lowest point in its career, and looks like we're in the process of starting to break away into some positives. So my expectation would be that this will probably be something you have to hold for years, but if you're looking for something that you can get in early, when the stock is still developing its character and developing its business, this might be a good opportunity. So I would say on the investment side, it looks like a great opportunity. On the trading side, I would say probably not the best choice because there will be better choices out there that can make quicker gains.
And that's a decision that we must make as traders and investors, is the risk that we take on positions like this. But the AI software is here to help us better gauge all of these different elements that do in time create value for the company. And so, if we got the institutions, we got the money flow. I see the earnings is coming out in November. You could get some of that upside like you showed. So great analysis, Mike. Thank you for bringing that one up to our attention. Moving on to our lesson of the week. And so there's so much in this platform. There's so many different features. Today, we're going to talk about the money flow screeners. And so, why is that important? Why should we, as traders, investors, analysts, keep an eye on the money flow screeners, and how does it work in the Madison trading software?
Fantastic question. So, folks, I'll answer that question by saying this. If you think about it, the hardest part of investing and trading is when to get in, right? So we can all analyze something and it looks decent, has good numbers, but at the end of the day, what makes us money is the price has to go from a lower place to a higher place, right? So we have to buy low and sell high. And the unfortunate thing is that we don't have our analysis. Like when I analyze a stock, what I think about it is not enough. I need to wait until I see the real buyers coming in. And who are the real buyers? The institutions. They're the ones who actually make the trends occur. And they're also the ones who stop the trends from continuing. So, since that is always the case, I need to make sure that I'm aware of what they're doing. So, what money flow does is it allows us to see when buying pressure is picking up, even before an institution actually reports that they're the one buying. And that's important to me because I know that that is what drives the price. It's the buying pressure or selling pressure. So if I can spot it when it's first starting, I get a leg up on anyone else who's waiting longer to actually see confirmation that, oh, BlackRock just bought a lot of shares of this stock, or the trend line's now up. I want to be able to get in earlier. So to do that, I need to use money flow. Now, money flow is basically looking at the total amount. So I'm going to go to the screener, or the total amount of buying versus selling. I'm just going to go to the scans, excuse me, and look at this. Now, the way I'm going to find it is, in this case, I'm just going to type in money flow into the search. And here it is. Money flow, today's top 20, money flow, 1 week top 20, money flow, today's low 20, money flow, 1 week low. So basically I can look for stocks where money's where people are buying, and also stocks that people are selling. Maybe I want to find a bearish case, but mostly you want to look at buying. So let's look at today. So I'm gonna click here, and now I have a list of all of the stocks, every one of them, that has showed up in the top 20 for money flow. So what is that going to look like? Well, I can just click around in each of these stocks and see what they're doing, but I can also click right here on the circle, which is going to take me right to the place I want to see. So I'm going to click on the circle, and sure enough, here, what do I see on iShares Trust? I see that we have a progressively taller green than brown setup, which means that brown means selling, green means buying. It's kind of brownish red, but either way, if I see that the top parts of the columns are taller than the bottom parts, that means there's more buying, and the green in the middle tells me how much more buying there is in selling. So the bigger the band is in the middle, the bigger the buying advantage, or if it's negative, the bigger the selling advantage. So these are all positive. So what this is basically saying is, for whatever reason, people are buying and buying and buying this. Now, what is this? It's the iShares Trust, but what is that? I'm going to click on the dashboard, and I see that it's the iShares 1 to 3 year Treasury Bond ETF. So for whatever reason, people are buying Treasury bonds, and I'm guessing, big guess, but probably right, that they're buying this ahead of the FOMC statement. Looks to me that this is accumulation of bonds just before the FOMC statement. Now I'm not sure what they're expecting to happen. Maybe these are people who are buying back bonds that they were short. I don't know. But whatever the case may be, there's a lot of buying. Okay, so if I go back to the scans again, I could look at other stocks out here. CEG, I don't know what that is, but let's check it out. Sure enough, has green, more overall buying than selling. And we can actually see a pretty clear trend on this. We have 101 fewer buyers, which is not good, but the overall institutional ownership went up. So what that probably means is that some of the institutions have been accumulating a lot of shares, but a lot of other institutions are just getting rid of their holdings for whatever reason. So this is getting more concentrated in the hands of a few funds, it looks like, and others are offloading it. But either way, institutional ownership is 80% overall, 80.08%, and it's up 3.05%. And there's been a lot of buying recently. So if I want to learn more about that company, I can look into it and try to figure out, well, why are these guys buying so much right now? Is there something going on? If I go back to the next another stock, let's say DoorDash. Here's one. I think that's DoorDash. Yep. And DoorDash right now is showing some positive money flow as well. Institutional ownership in this case is up 3.38% already. 119 more buyers, 104 fewer sellers, but it's in 5 fewer top tens. But either way, I can see that buyers are coming in, and the fundamentals on this company are already solid. They're in the green. The upside projections on this are huge. Right now, the stock is trading at 58.73. The minimum target is 67, so it's trading at a discount to the minimum target. The median target is 140.95. The highest is 280. So we can basically roughly guess that this stock has some great upside potential, and it looks like some buyers are actually snapping up shares now while the stock is on the decline. The revenue is definitely increasing at a pace that a growth stock should be seeing. Earnings are going to be up in the air for this because it's a newer company, so I wouldn't pay as much attention to that. I would pay mostly attention to the revenue growth, and also look at the cash flow growth as it if it does improve. But the overall targets are strong on this. But technically, the stock is on a decline, right? Now, I've said this to a lot of our subscribers multiple times, that a lot of times the best buying opportunities are going to be when the stock's on its low, but you have to wait for institutional buyers to show up. Now, I think they showed up primarily because of this. If I look at this graphic at the bottom, and I don't want to jump into two things at once, but this green over here means that that's when the fundamentals start to kick into solid gear. Like they had one brief period over here where they went green and then they went back to yellow. But now we've had a very solid block of green. and it looks like the market's responding. So I think it's because of where we are fundamentally. Looking at the targets, I think this is actually a very attractive place to look for a buy because we're now trading at that minimum price, just below it. So it doesn't mean it can't go any lower, folks. It just means that when you find a stock that has solid fundamentals but is trading below the minimum expected target, but it is showing good revenue growth over time, and there's really not much out there that says that it won't continue, that's usually a good time to trigger a buy. So I do think this is one of the strongest opportunities I've seen. But once again, we're not seeing the momentum yet. We're just it looks like there's some accumulation going on as the stock is going sideways. If we want to wait, we can wait for it to break out. But if you want to get into this where you're getting in at a relatively low price and there is definitely strong upside potential, then now would be a good time. So this is the sort of stock I usually feel comfortable buying if I'm going to hold it for a while. I do see this as a really good growth potential, especially looking at the industry they're in. I do think there's a lot of growth potential here. So this is one of the better contenders out there that we can find. So definitely worth taking a look at.
Once again, that feature is called the Money Flow Screener,
Yep.
one of the many amazing features in the Madison trading software. And so I'm going to once again invite anybody that's listening, watching for the first time to head on over to MadisonTradingSoftware.com, grab a copy of the software for yourself, get a demo, get a test drive, get in there, see if it's something that can work with you. It incorporates or it integrates with a lot of your favorite brokers already. So, seamless integration there. All right. We're about 40 minutes out from that Fed meeting. I think that once again, that's going to be the big news of the
Yep.
day. And we'll see what happens. Mike, anything else we should be keeping an eye on going into the end of the week, into next week, mid-September, heading into fall? What do you
Yep.
think?
Well, I know for sure after this meeting, Chairman Powell of the Federal Reserve of the United States will be speaking on Friday, so we do want to watch that as well. But other than that, there's not a lot of other things going on at the moment. Thursday is probably going to be fairly calm. Well, it may be calm as far as news is concerned, but we probably will see some volatility based on the FOMC. So that's the big one. FOMC meeting coming up in about 40 minutes, but then on Friday, we need to see what Powell has to say because that will add fuel to the fire. And then, based on whatever tone he sets, that's basically the direction the market's likely to go.
That sounds about right. All right. If you've enjoyed this stream, hit that like, hit that follow, hit that subscribe button. If you have any questions, feel free to leave it in the chat. Drop us a DM. Someone will get back to you. Otherwise, head on over to MadisonTradingSoftware.com and grab that demo and make some analysis for yourself and maybe bring us some ideas. Mike, thank you for your time. Thank you, everybody, for tuning in. We'll catch you guys next week.
Yep. Take care, folks, and take